thank you for joining me on FutureMoneyTrends.com. I'm here with James Turk, the founder and chairman of Gold Money. You can find his site at goldmoney.com. Quick disclaimer, I am a client of goldmoney.com. James, thank you so much for being on the show with us today.
Thanks, Danielle. It's a pleasure to speak with you.
James, you've been in the banking world, international banking, investment world since 1969. I'm so thankful to be able to talk to you. I'd like to get right into this. Are we looking at another 2008 where gold and silver are going to crash along with the markets?
Well, I think we're looking at another 2008 in the sense that I've been expecting another Lehman moment, and it sure feels like one is coming before the end of the year. But I think that's where the parallels or the similarities to 2008 end. 2008 was a liquidity event, and everybody was selling everything they could sell, not necessarily what they wanted to sell. But they were selling what they could sell in order to raise liquidity, to pay down debts, meet margin calls, and that type of thing. This time around, it's a little bit different. I think there's sufficient liquidity in the system. In fact, that's what all of the pump priming and quantitative easing has been from central banks around the world. And more importantly, I think the big fund managers recognize that, they have to keep some liquidity on hand given the volatility that we're seeing in these markets. So I don't expect a big sell everything you can liquidity push that we got like in 2008 after Lehman Brothers. This time around, I think you're going to be driven more by fear, the need to make sure your assets are safe rather than any kind of liquidity concerns. And in that kind of environment, I expect gold and silver to do the opposite of what they did in 2008. In 2008, they got sold along with everything else. They threw out the baby with the bathwater, as the saying goes. This time around, I think you're going to see good buying coming into the precious metals. And where we're at the moment, to me, is a super buying opportunity.
Now, James, you've got the bond crisis in Europe. We've got this thing with the super committee, and the U.S. just cannot get its financial house in order. Yet today, gold and silver are down. Is this just due to light volume overall because of the Thanksgiving holiday in the U.S.?
Well, it's due to the light volume. That is a big factor. It's not just Thanksgiving. I think the collapse of MF Global is still playing out in the paper markets. But, the people who are accumulating physical gold and physical silver and who have been accumulating it, for all decade long and are doing very well by accumulating that physical metal, they don't really care about what's going on in the paper markets. But, we're playing out the same pattern. At month end, when the option expiry comes and, the shorts try to sell the market down in order to make certain as few calls get exercised as possible, we're just sort of seeing that same thing again. But typically after the end of the month, both gold and silver start to rally. So I see this, end of month play, just a repeat of what we've seen many times before. And I'm quite bullish here on both gold and silver, and I think we're at or very, very close to the lows. Basically, we're just retesting the lows from last month.
Now, with Europe, I've read things that Europe is going to break apart as far as the Eurozone. And I've also recently read some things where there was a memo leaked from Germany where they were trying to build an even stronger European Union, a super Eurozone. How do you see Europe playing out over the next few months and next few years?
Well, I don't know about the next few years, other than that the euro itself is probably going to break up in some form. I just don't see how it's going to work. The next few months, though, are really quite interesting because almost anything can happen. The politicians made the wrong decision back when the Greece crisis was breaking out. They basically decided that no sovereign nation within the Eurozone could go bankrupt. Now, even though Greece cheated to get in the system and they broke the rules, etc. And what that did is it opened Pandora's box. It basically said, well, of the 16 members in the Eurozone, something like 13 of them were cheating on the rules, and the market just started picking them off one at a time. After Greece, Ireland, Portugal, now they're looking at Italy, and Spain's not far behind that. And the market's really not demanding anything. The market is just responding to what politicians and central bankers are doing to the currency, what politicians are doing to government deficits, and the market doesn't like what it sees. So, I think the euro is Europe in general is going to continue to spin out of control. The euro is, I think, very problematic. I don't think it's going to survive from a longer-term time perspective. There are just too many fragile breakpoints that could cause it to fall apart. But the more important point and the more immediate point is the sovereign debt that all of the governments have taken on, and the banks are sitting on. The banks are just chock full of this unrepayable sovereign debt.
James, one of the questions I've always wanted to ask somebody of your stature is, what are the deflationists missing? I hear great people who pretty much think the same way that you think when they look at the economy, when they look at the debt crisis. But then their forecast for the result is not a currency crisis, not a hyperinflationary situation, but deflation. What is it that the deflationists are not seeing? What are they missing?
Well, there are a couple of answers to that question. It's a really good question. First of all, you have to decide: are you looking at the inflation or deflation? Are you measuring it in terms of dollars, or are you measuring it in terms of gold? If you measure prices of goods and services in terms of dollars, prices are still going up. But if you measure prices in terms of ounces of gold or grams of gold, prices are going down, which is another way of saying that the gold price is rising in terms of dollars. So we are getting a deflation when you measure prices in terms of gold, but you're getting inflation when you're measuring prices in terms of dollars. That's one aspect of it. And that relates back to the 1930s. In the 1930s, the dollar was tied to gold. So as a consequence, what happened was the quantity of dollars was actually decreasing in the 1930s. Today, the quantity of dollars is not decreasing at all. It's continuing to increase, and the Federal Reserve and central banks around the world are making sure that money supplies everywhere are continuing to increase, which is why you get these inflationary pressures. But here's an interesting point. People look at housing prices, and they say, well, housing prices are going down. Well, that's not deflation. That's just falling prices in a sector that was way overpriced, way overvalued to begin with. So you're measuring that decline in housing prices with a currency. If you're using dollar to measure those housing prices, you're measuring that decline in housing prices with a currency that's being ever inflated. So you do get a lot of these different cross currents, and it's hard to sense what's really going on. But we are in a 1930s style deflation if you measure prices in terms of gold. But if you measure prices in terms of dollars, we're actually seeing inflation.
Now, James, a lot of people I hear compare this gold run to the 1970s. In your opinion, is that a good comparison?
Well, yes and no. It's a good comparison in the sense that the 1970s, actually it was the 1960s and 1970s, because it really started in the 1960s. It's a good comparison in the sense that bull market was maybe 15 years long. And I think this one's probably going to be 13, 14, 15 years long before it's finished. So we've got several more years left to this bull market. But and it's also good to compare them in the sense that in the 1970s, the market, just the price of gold just kept going higher and higher and higher. Yes, there were corrections, but it basically just went much higher than I think anyone was possibly expecting at the beginning of the decade. So I think that's a good point to take away from the 1970s as well. That the way to attack a major bull market is just continue accumulating it until it becomes overvalued. And gold, by all of my measures, is not overvalued at this moment. In fact, it's still very undervalued. And consequently, I continue to recommend the same thing I've been recommending all decade long, which is a cost accumulation program. Every month, just buy some precious metals, physical gold or physical silver, view it to be a form of savings, put it away, and forget about it until the next month. Don't focus on the price. Just buy it on the same day of the month, and over time, you'll be averaged in at a very, very attractive level. But there is a big difference between now and the 1970s. The problems now are much worse. Back in the 1970s, the U.S. was the largest creditor nation in the world, and now it's the largest debtor nation in the world. You didn't have these horrific government deficits that you in the 70s that we're seeing today. You didn't have this mountain of derivatives. You didn't have things like CDSs and all these exotic derivatives, that are hanging over the banks like a sword, ready to chop the banks into pieces as soon as somebody defaults on a debt, because the net exposure now becomes gross exposure on these derivatives, and insurance that the banks thought they maybe had against a Greek default or an Italian default really isn't worth anything, and that they could end up taking some horrific losses. So, it's like anything else, Daniel. Sometimes, things can be compared, but, there are always some differences that have to be taken into consideration. And while you can generally take away some key points from the 1970s to compare today, I think today is much worse than back then, and consequently, I think we can expect a much higher multiple in the gold price this time around than we could back in the 1970s. Gold went from 35 to 800 back then. This time, I think it's going to go a much higher multiple than it did back that time, simply because of the problems are so much greater.
What is your current ultimate price target for gold and silver?
Well, my long-standing target goes back to an interview in Barron's in 2003 when gold was about $350 an ounce. And I was saying that when this financial bust is over, because it was clear to me we were already in a financial bust back then, that we would probably be at $8,000 an ounce sometime between 2013 and 2015. But central banks have done such a poor job managing the purchasing power of currency, even worse than I was expecting, and I wasn't giving them much credit for it. That actually, I think that $8,000 level is a little bit low. And I've just recently been doing some work on some of my long-term valuation models, and I think something like $11,000 might be closer to the mark before this is all said and done. I mean, that number may sound a little bit crazy, but what I explained to Barron's was that I was just basically saying history is going to repeat. If gold can go from $35 to $800 in the 1970s, which it did, history can repeat by taking it to $350 to $8,000, because the $350 in 2003 was essentially the same purchasing power as $35 was in 1971. The inflation over the intervening 32-year period caused the dollar to purchase less. So on an inflation-adjusted basis, going from 350 to 8,000 is no different than what happened in the 1970s. But I think it's going to be a little bit worse than the 1970s. You're actually going to see a higher gold price. That's why I'm sort of focusing on 11,000 now. I'm still thinking 2013 to 2015.
Will it be a sudden shock in the gold price? I mean, because as of right now, we see the gold price go up a few $100s a year. Is it going to just be one day, the gold's at 2,500, and then all of a sudden we wake up and gold is spiked to like $5,800?
It could. Right now we're in what I've been calling a managed retreat. The governments that have been trying to control and cap the gold price have allowed it to go up 15, 16, 70% per annum, depending which currency you're measuring gold in over the last 10 years. So they're allowing it to retreat because they recognize gold is undervalued, and they don't want the lid to go flying off the pressure cooker all at once. So they can't keep the price down low, so they just allow it to go up a little bit, a double-digit number every year. That double-digit number basically reflecting how much currencies are being debased during the course of a year. So that's been what's been happening so far this decade. But now, given the mounting problems that are becoming more and more apparent, and also, given the fact that physical gold and paper gold, I think, are separating more and more. Same thing with silver, perhaps even more so with silver than with gold. And people starting to understand that gold is very good value, and most importantly, people starting to understand that in a financial bust, a lot of promises are broken, and therefore you don't want to have counterparty risk. And you don't have counterparty risk when you own physical gold or physical silver for the simple reason that they're tangible assets. The value isn't based on someone's promise or any bank's or firm's balance sheet. So all of these things are coming to the fore, and I think you could see gold ratchet up more quickly at any one time. I think we got a little bit of a flavor of that back in August, when the gold price shot up the way it did. But I think the key is that you have to remember every bull market has three stages. The first stage is apathy and neglect. No one's paying attention. And that's what happened until gold was broke over $1,000. Then it went into stage 2. So we're in stage 2. I don't think, though, the big, dramatic moves are going to come until you get to stage 3. That's when the speculators start jumping in and, your neighbors start telling you to buy gold, that kind of thing. And that's still, I think, down the road. That's 2013, 2015. The interesting thing about silver is it's still in stage 1. It's not going to get over stage 2 until it clears $50 an ounce. And I think that's probably going to happen. It's not looking like it's going to happen this year, but it probably happen in the first half of next year.
With the World Gold Council just reporting some numbers that central banks have increased their quarter-to-quarter gold purchases by 20%, and as you're fully aware, central banks have been net buyers of gold for the last few years, and as well as just governments in general. Is it possible this decade where the world has some tie to gold again as far as one of the currencies?
I don't think so. Central banks and, more importantly, governments don't want to be tied down by the discipline of gold. They just want to create money out of thin air. So I don't see it being tied to any currency. In fact, I really expect all fiat currencies to collapse and faith in government management of the currency to be completely destroyed, with the currency going back to where it should belong and where it's always been, except for the last century or so. It's a product of the free market. It's a product of private enterprise. It's a service, just like all services are better served when they come from the private market rather than coming from government. And the reason for that is that, businesses try to deliver a good service so that they have make a profit and stay in business. But governments don't have any bottom line accountability. They don't care about the service they deliver. They're just serving political objectives and the objectives of the vested interests that control a government. So I don't see governments going back to gold. I really don't. And in fact, I get discouraged when I see central banks buying gold for the simple reason that governments shouldn't be in the money business. They shouldn't be in any business. Governments are there to protect the rule of law. That's it. They should get out of the money business. And we've seen, what a terrible job central banks have been doing. That's why I call central banking the barbarous relic. The barbarous relic is in gold. It's central banking.
Mm. James, on the streets of America, people are selling gold for literally 10 cents on the dollar. Inside Edition did a story about it where people are sending their gold in the mail to this company and literally they're getting 10 cents on the dollar. I recently was at a birthday party and somebody handed me a flyer to attend a gold party at a future date. And it's the same thing. People show up and they get rid of their gold for, again, they're selling their gold for $200 an ounce. What are the streets of Europe like? I mean, is Europe, are the people buying gold? Are they seeing, the gold commercials on the news like we are? Are people just completely ignorant of gold? What's the Europe street like?
Well, I think there is a very broad and widespread ignorance of gold. And that's to be expected because of government propaganda, bashing gold all of the time, and academics, saying gold has no use in the modern economy. But, gold's been money for 5,000 years. For 40 years, we've been experimenting with fiat currency backed by nothing except government promises. And we see now how badly that experiment has gone. So, people are rediscovering, what's, those attributes and characteristics that made gold as money in the first place. They haven't been lost or destroyed. They've just been ignored or been forgotten. And, as the gold price rises, more and more people are starting to understand those characteristics that made gold money in the first place are still there. So the level of education, I think, is improving. Also, with regard to the sales of gold, we saw a lot of that in Europe, after the Lehman collapse. And basically, gold was doing what it's supposed to do. It's your rainy day money. And if you need it to pay the rent or, pay the mortgage, you're going to sell some gold so that you can stay current. And that's what happened, after the Lehman collapse. Gold was fulfilling its normal function. But a lot of that has disappeared. I think you're seeing now a lot more buying than you're seeing any selling. In part, I think, because people became a little bit wiser. Instead of being ripped off by selling jewelry for next to nothing, they're starting to understand that that jewelry they have at the back of the dresser, even if they're not wearing it. It's got a lot more value to it than what they otherwise thought.
James, if someone would like to contact you or learn more about gold money, where's the best place to go?
Yeah, the best thing to do is just go to goldmoney.com. You can open a holding, which is free to do, and have a chance of looking around, what we actually offer. We're basically safeguarding now $2.1 billion of gold and silver owned by 22,000 customers in 100 different countries around the globe. And, it comes down to, Daniel, when you're buying physical metal, there are only two ways to do it. You buy it and you store it yourself, or you buy it and have someone store it for you, which is what we're doing in Gold Money. But if you choose the second option of professional storage, you have to make certain that your gold is absolutely safe, because it is the bedrock asset in your portfolio, and you don't want to take risks with it. So we have the industry-leading governance procedures, audits, insured vaults, etc. And these audits, for example, are available to customers when they log into their holdings, so they can read and see the confirmations that the gold that they own is really there in the vault. So, if you're looking around for professional storage, you have to make certain that the company you're choosing has safety and governance procedures similar to those that we use in Gold Money, the most important of which, of course, is the audits. Also, there are advantages to storing some of the gold outside the country where you live, because one never knows whether gold's going to become an object of confiscation again in the future. So the way to mitigate that risk is to diversify your gold holdings as best as possible, and that's one thing we can help you do with Gold Money. We're a European-based company, but the gold storage facilities we offer are located in London, Zurich, or Hong Kong. In any one or all three of those locations where you can choose to store your gold, silver, platinum, or palladium.
Now, gold money is probably the simplest way, as far as I know, for an American to have an offshore account, correct?
Yeah, it's not an account, it's a holding. There's a fundamental difference between the two. An account means you have a relationship with, say, a bank or a brokerage firm, and they have a liability to you. A holding is different. It's a tangible asset that you own, and we're simply storing it for you and safeguarding it according to your instructions. It's more like a corn silo in the Midwest. The silo operator doesn't own the corn. The farmer owns the corn. And that's much different than depositing your money in the bank where you actually have an account.
Now, I know you're not an attorney, but does gold money offer the same as far as liability protection for people who open an account? Because the holdings are offshore for Americans, correct?
Yeah, it's the gold or silver, platinum, palladium you own are stored in vaults located in London, Zurich, or Hong Kong. And the vaults that we use vaults by two different companies. All the vaults are insured. So your precious metals are, and first of all, they're in a specialized bullion vault, and secondly, they're insured.
Great. Well, thank you so much for telling us about gold money and sharing your thoughts on the overall markets, James. Appreciate it.
Yeah, I'm quite happy to do it, Daniel. And if you want to do this again in the future, I'd be more than happy.
Thank you so much.